Have you ever wondered why some investors consistently build wealth over decades, while others, despite their intelligence and market knowledge, end up losing everything? What if the secret to financial success isn't about making brilliant moves, but rather avoiding catastrophic ones? This question lies at the heart of Charlie Munger's investment philosophy, a strategy that helped build one of the greatest fortunes in modern history, alongside Warren Buffett at Berkshire Hathaway. But before we begin, please hit the like button and let me know where in the world you're watching from today. It's always fascinating seeing who's joining us from around the world. And if you haven't already, make sure to hit that subscribe button and turn on the notification bell so you don't miss any of our future videos. Has this ever happened to you? You discover a hot stock tip that promises quick returns, invest a significant portion of your savings only to watch its value plummet weeks later. So you're not alone. The investing world is littered with stories of smart people making devastating financial mistakes. But what if there was a better way? The first rule of compounding is to never interrupt it unnecessarily, Munger often said. And the fastest way to interrupt compounding is to lose money. While this might sound painfully obvious, like telling someone not to stick their hand in fire, the world remains full of investors with burned hands and empty portfolios. The magic of compound interest, what Einstein allegedly called the eighth wonder of the world, only works when you allow it to continue uninterrupted year after year, decade after decade. After more than half a century of investing experience, witnessing markets rise, collapse, recover, and collapse again, Munger distilled his wisdom into a counterintuitive insight. Survival in the investment world comes not from chasing brilliance, but from avoiding stupidity. Stay with me until the end, because this perspective might completely transform how you think about building wealth. What you're about to discover might surprise you. The investors who endure and prosper over the long term are rarely the ones with the highest IQs or the most sophisticated trading strategies. Instead, they're the ones who consistently avoid major mistakes that interrupt the compounding process. It's not about being the smartest person in the room. It's about not being the dumbest. Think about it. A 50% loss requires a 100% gain just to break even. One catastrophic investment decision can erase years of careful growth. This is why Munger believed protecting your capital is more important than squeezing out extra percentage points of return. While others chase the next big thing, those who follow Munger's philosophy focus on a different question. How can I ensure I'll still be in the game a decade from now? The beauty of this approach is that it doesn't require exceptional intelligence or insider information. It requires something perhaps more rare in today's fast-paced market environment: discipline and patience. But what exactly does avoiding stupidity look like in practical terms? And how can average investors apply these principles to their own financial decisions? The answers might be simpler than you think. If you're serious about building lasting wealth through timeless principles, hit that subscribe button now to join our community of thoughtful investors. The journey that shaped Munger's investment philosophy begins with a profound transformation during his formative years. Growing up in Omaha during the Great Depression, Munger didn't learn about risk management from textbooks. He witnessed its consequences firsthand on every street corner. This wasn't abstract financial theory. It was the raw reality of human suffering that etched itself permanently into his mindset. Men with good jobs were selling apples on the street. Families were losing their homes. You could buy a farm for the price of a used car, he often recalled. What struck young Charlie wasn't just the economic devastation, but the pattern behind the collapse. The revelation was clear. Families weren't destroyed by bad luck, but by overconfidence, a fatal assumption that tomorrow would resemble yesterday. The hidden truth Munger discovered was that debt became the executioner when economic tides shifted. Those who had borrowed heavily against a prosperous future suddenly found themselves underwater when that future never materialized. Meanwhile, those who remained conservative in their financial decisions, living below their means and avoiding excessive leverage, survived to tell the tale. This behind-the-scenes education during America's darkest financial chapter permanently altered Munger's perception of human decision-making. It cured him of any naive optimism about rational markets or rational investors. The impact was so profound that decades later, every investment decision he made still carried the echoes of those Depression-era lessons. Fast forward to the turbulent 1970s, a period of rampant inflation, skyrocketing oil prices, and market collapses. While many celebrated investors were being wiped out, Munger wasn't demonstrating genius. He was simply applying the caution his early life experiences had instilled in him. "I wasn't a genius, I was just cautious," he admitted with characteristic bluntness. "I avoided debt. I avoided hot tips. I avoided whatever was fashionable." This disciplined approach may have looked boring, even foolish, during bullish periods when others were boasting about quick gains. But while they were riding roller coasters of volatility, something remarkable was happening in Munger's portfolio. Compounding was working quietly in the background. Year after year, decade after decade, his wealth grew gradually but inexorably, not through spectacular wins, but through the consistent avoidance of catastrophic losses. It's a counterintuitive principle that challenges our natural instincts. Sometimes the path to extraordinary results comes through deliberately ordinary actions. Now, I want to go even deeper into this topic by exploring what might be Munger's most controversial belief, that not losing is actually more important than winning in the investment world. It's an idea that runs contrary to everything we're taught about achievement and success, yet it forms the cornerstone of his investment approach. If this approach to wealth building resonates with your own experiences, write "Patience pays" in the comments below. This revelation about the power of avoiding losses over chasing gains might be the most profound mindset shift in Munger's investment philosophy. "Not losing is more important than winning," he insisted, a statement that runs counter to our achievement-oriented culture. It's a principle most investors resist with every fiber of their being. Why? Because it lacks the excitement, the adrenaline rush that comes with pursuing big wins and quick riches. "People hate hearing that," Munger observed with his characteristic bluntness. "They want to win big. They want to triple their money by Tuesday." But here's the uncomfortable truth he discovered over his investing journey. This very urge to hit the jackpot actually destroys more wealth than poverty ever did. The casino metaphor he often used illuminates this perfectly. Those dazzling lights on the Las Vegas Strip aren't paid for by winners. They're funded by losers who believed they had a system. The stock market operates on similar psychological principles, just with bigger numbers and better-dressed participants. Behind the scenes, this gambling mentality drives millions of investors to make decisions that systematically transfer their wealth to more disciplined players. It's a painful cycle of human behavior that repeats generation after generation. Munger's own evolution as an investor included moving beyond what Warren Buffett called cigar butt investments, companies so cheap they might have one last puff of value left in them, like finding a discarded cigar on the street that offers one free smoke. Early in his career, Munger was drawn to these apparent bargains, companies trading below their asset value that seemed to offer a mathematical edge. "I remember once investing in a company that looked cheap. A real cigar butt deal," he confessed. But these bargain bin businesses taught him an expensive lesson through disappointment after disappointment. "The smoke was free, but the stink stayed with me for years," he remarked with characteristic self-deprecation. This watershed moment in his investment education led to a fundamental insight. cheap junk is still junk. The transformation in his thinking wasn't just philosophical, it was financial. Munger candidly admitted that the mistake of buying poor-quality businesses merely because they appeared statistically cheap likely cost him more money than he cared to count. The damage wasn't just the capital lost on those specific investments, but the opportunity cost of what that capital could have achieved if deployed in truly exceptional businesses. This progression in Munger's thinking represents a powerful distinction that separates amateur investors from masters of the craft. While beginners fixate on finding deals based primarily on price, the seasoned investor understands that quality, sustainable competitive advantages, high returns on capital and capable management ultimately determines long-term results. It's a perspective that values substance over statistical cheapness. Let's explore how this philosophy led to perhaps the most significant insight in Munger's career, that paying a fair price for a wonderful business is infinitely better than a bargain price for a mediocre one. If you've ever purchased something cheap that ended up being a waste of money, type "quality matters" in the comments. This quality over price revelation leads us to another profound insight from Munger's investment journey, the psychology behind our worst financial decisions. If you want to ruin your life and your portfolio, Munger observed, envy will do the job faster than any market crash. In his characteristic no-nonsense style, he called envy the dumbest sin because, unlike other vices, it doesn't even provide temporary pleasure. Lust can be fun. Gluttony at least tastes good. Pride feels nice for a while. But envy is like drinking poison and waiting for the other person to die. The psychological breakthrough here is recognizing how comparison destroys rational decision-making. Throughout his decades in financial markets, Munger witnessed a disturbing pattern: people with good incomes and perfectly decent lives becoming deeply unhappy because someone in their circle was doing slightly better. Their neighbor drove a nicer car. Their classmate bought a bigger house. Their colleague got rich faster on some speculative investment. This toxic mindset creates a devastating ripple effect on investment behavior. Once envy takes hold, previously sensible investors suddenly feel compelled to abandon sound principles just to catch up. The emotional trigger overrides logical thinking, pushing them to chase whatever seems to be working for others. Tech stocks in the 1990s, real estate in 2006, cryptocurrency in 2021. Different years, same stupidity, as Munger bluntly put it. The watershed moment in Munger and Buffett's partnership came when they deliberately chose a different path. We didn't waste much time on envy. We didn't care if someone else doubled their money while we were sitting still. This freedom from social comparison allowed them to make decisions based on business fundamentals rather than emotional reactions to what others were doing. The revelation was that sitting still with the right asset was often the smartest move, even when it looked boring compared to the latest investment fad. Yet even these investment legends weren't immune to mistakes. Behind the scenes of Berkshire Hathaway's incredible success story lies a history of errors and missed opportunities that shaped their approach. People like to imagine that Warren and I sat in an ivory tower making perfect decisions all day, Munger reflected. That's nonsense. We screwed up plenty. We just avoided the kind of screw-ups that put you out of business. One of their most significant miscalculations, a mistake that Munger still reflected on decades later, was underestimating how valuable certain businesses would become if left to compound over extremely long periods. They passed on investing in companies like Coca-Cola before eventually buying it, because the price seemed too steep at the time. The epiphany came when they realized they had been too focused on the price tag and not enough on the extraordinary quality of the business. This brings us to a fascinating paradox in Munger's investment philosophy. What looks expensive initially can actually be the bargain of a lifetime if the business quality is exceptional enough. Let's examine how this counterintuitive principle transformed Berkshire's approach to building wealth. If you've ever missed an opportunity because you thought something was too expensive, write opportunity cost in the comments. This paradigm shift in Munger's investment philosophy crystallized into a principle that would revolutionize Berkshire Hathaway's approach. Paying a fair price for a great business is better than a cheap price for a lousy one. This insight represents one of the most profound mindset transformations in modern investing history. The revelation seems simple in retrospect, yet it runs counter to the bargain-hunting instinct that drives most investors. Overpaying for quality is still safer than underpaying for garbage, Munger would explain, because garbage goes to zero while quality compounds. This wisdom illuminates a hidden truth about wealth creation that most investors never grasp. When you buy a mediocre business at a seemingly attractive price, you're often acquiring something that time will work against. Conversely, when you own an exceptional business with strong competitive advantages, time becomes your greatest ally. Subscribe now to access more deep dives into the wisdom of legendary investors who transformed the financial world. These are lessons you won't find in textbooks. The epiphany that changed Berkshire's trajectory wasn't just theoretical, it manifested in concrete decisions about capital allocation. The real mistake isn't paying 20% too much for Coca-Cola, Munger observed. The real mistake is never buying Coca-Cola because you're too busy hunting for bargains in the trash heap. This perspective challenges the conventional wisdom that successful investing is primarily about finding deals and steals in the market. Behind the scenes of this philosophical evolution was a deeper realization about the nature of wealth creation. Most investors obsess over entry points, the buying and selling, believing that's where the magic happens. Munger's journey led him to a different conclusion. The big money in investing isn't made in the buying or the selling, it's in the waiting. This single insight encapsulates a dimension of investing psychology that separates the truly successful from the perpetually struggling. The breakthrough here is recognizing the asymmetric relationship between time and business quality. For exceptional businesses, time is a powerful ally that allows compounding to work its mathematical magic. For mediocre or poor businesses, time is actually an enemy, gradually exposing weaknesses and eroding whatever temporary advantages might have existed. This distinction creates an illuminating framework for evaluating investment opportunities. Reflecting on his decades in the market, Munger identified a form of opportunity cost that rarely appears in investment textbooks. The worst mistake isn't the money lost on bad investments, he noted, but the money never made because of underestimating obvious quality businesses and the power of patience. This represents a fundamental shift in how we calculate investment success, from avoiding visible losses to recognizing invisible missed gains. The patience Munger advocates isn't passive waiting, but rather an active discipline that allows compounding to work. Uninterrupted, it's the discipline to resist trading activity for its own sake, to ignore market fluctuations that don't reflect business reality, and to hold positions through periods when they appear overvalued by conventional metrics. This approach requires a remarkable psychological resilience that few investors develop. Now let's examine how this quality-focused, patient approach contrasts with one of the most dangerous forces in investing: overconfidence and the illusion that we know more than we actually do. If you've ever held onto a quality investment through market turbulence and been rewarded for your patience, write diamond hands in the comments. Overconfidence represents perhaps the most insidious threat to wealth creation, operating silently beneath the surface of most investment failures. If you want to know why most people lose money, Munger observed, It isn't bad luck. It's overconfidence. This revelation gets to the heart of a psychological blind spot that affects even sophisticated investors. We systematically overestimate how much we actually understand. The breakthrough insight here is recognizing that financial markets create a uniquely dangerous environment for human decision-making. We read a few articles, watch some financial news, or hear about an industry from a friend, and suddenly we believe we comprehend complex global systems that have defeated even the brightest minds. This illusion of understanding leads directly to financial disaster. I've watched men sit in boardrooms certain they could outsmart the world, Munger reflected. They'd say things like, "This time is different," or "The old rules don't apply anymore." Every time I heard that, I knew trouble was coming. This pattern of delusional certainty has repeated throughout market history, from the tulip mania to the dot-com bubble to the 2008 financial crisis. The contrarian wisdom that emerged from Munger and Buffett's partnership seems almost paradoxical. They stayed rich by openly admitting what they didn't know. Rather than pretending to understand everything, they developed a disciplined awareness of their circle of competence, the boundaries of what they genuinely understood. This intellectual humility protected them from countless investment disasters. Take the airline industry as a case study in this approach. For decades, Berkshire avoided airline stocks despite their apparent attractiveness. They looked like death traps, Munger explained. Capital-intensive, cyclical, union problems, fuel costs, all working against investors. We knew we weren't smart enough to pick the winners in that mess. This single decision to stay within their circle of competence saved them from what Warren Buffett later called a century of disasters in aviation investments. This enlightenment about overconfidence connects directly to another transformational insight in Munger's philosophy: the distinction between thinking like an employee versus thinking like an owner. One big reason people lose money, he noted, is that they think like employees instead of owners. This mindset difference creates profound divergence in decision-making over time. Employee thinking optimizes for the next quarter, the next promotion, or the next bonus, not the next 20 years. It creates a warped incentive structure that prizes short-term appearances over long-term substance. Careerism makes people play it safe in all the wrong ways, Munger observed. They protect their job instead of protecting the business. They protect their ego instead of protecting their capital. The revelation here is that this employee mentality extends far beyond corporate executives to infect individual investors as well. When we constantly check portfolio values, chase the latest trends, or make decisions based on what will look good at the next family gathering, we're exhibiting the same short-term thinking that destroys corporate value. If you've ever caught yourself making an investment decision because you wanted to look smart rather than because you truly understood the business, write ego check in the comments. The distinction between employee and owner thinking leads us to another transformative principle in Munger's wealth preservation playbook. If you want to not only build wealth, but keep it, he suggests a profound simplification. Avoid 3 specific hazards that consistently destroy fortunes. If you really want to stay rich, or at least avoid going broke, Munger advised, learn to avoid 3 things: debt, drama, and dumb people. This trinity of wealth destroyers represents a powerful framework for evaluating almost any financial decision. First, debt, which Munger describes as like a loaded gun. The revelation here is that debt can kill your financial future even when you believe you're being careful with it. One bad turn, one crisis, one unexpected event, and suddenly you're insolvent, he observed. This warning isn't just theoretical. Munger witnessed its devastating consequences during the Depression, again in the 1970s, and repeatedly throughout market history. The second wealth destroyer, drama, refers to unnecessary complexity, chaos, and emotional baggage in your financial life. The breakthrough insight is that drama doesn't just create stress, it actively interferes with sound decision-making by wasting mental energy, clouding judgment, and obscuring simple truths. I've seen entire companies destroyed by feuds between executives who couldn't stand each other, Munger noted. I've seen investors ruin themselves chasing get-rich-quick schemes because they couldn't resist the thrill of action. The third wealth destroyer, dumb people, may sound blunt, but it reflects a hard-earned wisdom about the contagious nature of poor decisions. Avoid them like the plague, Munger advised, not out of elitism, but from recognizing a pattern. Bad partners can ruin you faster than a bad market. The journey to financial security requires vigilance about who influences your thinking and decision-making. One person's poor judgment can undermine decades of careful wealth building. This framework illuminates an essential truth. Success in wealth creation often comes not from extraordinary brilliance, but from avoiding common hazards that most people stumble into repeatedly. Most people are busy chasing the next big opportunity, Munger observed. I'm more interested in dodging bullets, survival first, wealth second. This philosophy of avoiding obvious mistakes rather than chasing brilliance is perfectly embodied in the legendary Munger-Buffett partnership. People often romanticize their collaboration as two geniuses in a room pulling magic ideas out of thin air, but the reality behind the scenes was far more instructive. That's nonsense, Munger clarified. What really worked was discipline, patience, and a refusal to do stupid things. The revelation about their partnership challenges our cultural obsession with genius and brilliance. What made Berkshire Hathaway successful wasn't primarily intellectual firepower, but rather a shared temperament, a willingness to look foolish for long stretches of time while following sound principles. When everyone was chasing dot-com stocks in the late 1990s, Munger and Buffett sat on their hands. We looked like idiots for about 2 years, Munger admitted. Then the bubble burst, and we looked like geniuses. Another foundation of their partnership that often goes unnoticed was absolute trust. I never worried about Warren stabbing me in the back, and he never worried about me, Munger reflected. That saved us enormous amounts of energy. This mutual confidence allowed them to focus entirely on investing rather than office politics or protecting their interests from each other. If you've ever had a toxic relationship, personal or professional, that cost you money, write "trust matters" in the comments. The relationship between trust and wealth creation brings us to one of Munger's most liberating revelations: the myth of getting rich quick. I never had a grand plan to become a billionaire, he confessed with characteristic honesty. It just happened because I avoided enough dumb mistakes and let compounding do the heavy lifting. This admission offers a refreshing counter-narrative to the dominant cultural mythology around wealth creation. The transformation in thinking here is profound. Most significant fortunes aren't built through brilliant maneuvers, market timing, or secret strategies. They're built slowly, almost invisibly, through consistent discipline, while everyone else is distracted by the pursuit of excitement and quick wins. The people who get rich quick, Munger observed, usually lose it just as quickly. This pattern repeats across generations because it's rooted in fundamental human psychology. The breakthrough insight is that true wealth accumulation operates more like a background process than a series of dramatic events. While most investors are fixated on finding the next Amazon or Bitcoin, the patient, disciplined investor simply keeps their costs low, holds cash when nothing looks attractive, and waits for opportunities where the odds are heavily tilted in their favor. You don't need brilliance to do that, Munger noted. You need patience, and patience is in short supply. This patience deficit creates a remarkable paradox in financial markets. The Average investor obsessively reads headlines, panics when prices drop, and gets greedy when prices rise, always chasing something. Hot stocks, hot sectors, hot tips. The predictable result? Buy high, sell low, repeat until broke, as Munger wryly observed. Meanwhile, those who quietly maintain spending below income, avoid debt, and invest in durable businesses, accumulate wealth almost by accident. After 99 years of life experience, witnessing everything from the Great Depression to the dot-com bubble to the 2008 financial crisis, Munger distilled his wisdom into a deceptively simple conclusion. The secret to not losing money isn't complicated. It's discipline, not brilliance or genius. I've seen empires collapse, bubbles inflate and burst, and entire industries disappear, he reflected. Every time, the people who survived were the ones who avoided the obvious mistakes. The journey to financial survival doesn't require extraordinary intelligence or insider information. It requires something perhaps more rare: the discipline to resist stupidity in all its forms. The survivors didn't borrow recklessly, they didn't chase fads, they didn't let envy, arrogance, or greed run the show. They lived below their means, bought things they understood, and partnered with people they trusted. This fundamental approach has protected wealth through wars, depressions, hyperinflations, and every other financial catastrophe throughout modern history. The hidden truth that emerges from Munger's lifetime of experience challenges our conventional understanding of investing psychology. Success comes not from being the smartest person in the room, but from avoiding being the dumbest. It's not about outsmarting everyone else. It's about not outsmarting yourself through overconfidence, impatience, or emotional decision-making. If you found yourself nodding in agreement with this counterintuitive approach to wealth building, write "Simplicity wins" in the comments. So there you too have it, Charlie Munger's lifetime of wisdom distilled into principles that anyone can apply. What strikes me most about his approach is how it runs counter to almost everything we're taught about success. While the financial world screams for complexity, Munger whispers for simplicity. While others chase excitement, he embraced boredom, and in doing so, he built one of the greatest fortunes in history. I hope these insights have given you a fresh perspective on how wealth is really created, not through flash and brilliance, but through discipline and patience. If something in this video resonated with you, perhaps changed how you think about investing or even life decisions, I'd love to hear about it in the comments. Just write "Wisdom over wizardry," so I know you made it to the end of our journey together. If you found value in these timeless principles, consider hitting the like button. It helps others discover this content who might benefit from Munger's unconventional wisdom. And if you're interested in more deep dives into the mindsets of history's greatest investors and thinkers, subscribe to join our community of thoughtful investors who value substance over hype. I've put together a video right here on Warren Buffett's complementary approach to investing that pairs perfectly with what we've discussed today. Click and join me there to complete the picture of how these two remarkable minds built Berkshire Hathaway through principles anyone can apply. Until next time, remember, it's not about being the smartest person in the room, but about avoiding being the dumbest.